Hi everyone, welcome back to Slevin Figures. In today's episode, I'll be providing you all with an update of the growth, the dividend, and the Boglehead portfolio, also known as the balanced portfolio. This is episode 13. I can't believe I've made it this far. $30,000 is the size of the portfolio. So we're working with some real capital here. A lot of capital is at risk. And the focus of today's episode is going to be on the growth portfolio, which is up a whopping 102% since we started this experiment of comparing growth to dividend to Bogleheads. In the first episode that I did on this channel, I actually said you can never have downside to investing. Investing is a great idea. How this plays out in the end, I'm always going to come out ahead because at least I'm putting my capital to work. And we're seeing that here with this portfolio. With that said, we're going to go ahead and kick things off with the Boglehead portfolio. Then we'll do the dividend and then finish things up with growth, showing which companies are doing really well in that portfolio. Let's head over to the Boglehead portfolio now. Okay, now that we're here in the Boglehead portfolio, this is also known as a balanced portfolio. This one has two funds in it, a total. Let me go down here and actually show it to you so that way you can follow really well. We have the Total World Index Fund right here, which is up 6.71%. And we have the Vanguard Total Bond Market, which is up 9.96%, so basically 10%. So if you just invested your money last year in the total bond market, you'd be up 10% right now. That definitely beats putting your money in the bank where you're earning maybe 1% or even less than 1%. So investing in bonds or debt is not always a bad idea. This is the simplest portfolio you can have. It's two funds. They're both balanced 50-50. And as you can see, in the 1 year that we've been doing this experiment, this portfolio is up 8.33%. That's better than anything you're going to get at the bank. That's better than anything that you're going to generally get from a being super conservative. It's up $507. So out of the $507, we can see that $159 came from the dividends earned that have been paid out by the index fund as well as the bond fund. And in terms of market gains, we're up $347. This is, again, I'm going to emphasize, the simplest portfolio you can probably recommend to someone. Whenever I have friends, family who don't want to deal with complexity of investing, but want to start at least putting their money somewhere where it can work, this is the go-to fund that I recommend to them. And it's what I would recommend to anybody who even watches this channel. Simplify things, put your money in two funds, maybe not 50-50, it could be 70-30, could be 80-20, depending on your age. But you put it there, just keep contributing every month or every week or every 2 weeks, and then go live your life. You'll wake up and you'll be doing very well when you turn 50 or 60 or whenever you start deciding to leave the workplace and go retire. But this portfolio is up 8.33%. Not much else to really explain here. We'll move on to the dividend portfolio. So here we are at the dividend portfolio. This portfolio continues to struggle in this comparison. We're sitting at minus 9.29% or 9.3%. So around negative $567. Even with the dividends that we've been getting paid, which is, we got $240 worth of dividends. Unfortunately, our market gains have been negative $807, which has overwhelmed our dividend payouts to land us at that $567. So this portfolio has about 60 stocks, and you won't be able to see them here individually because they've been bucketed into these slices. Basically, I have 12 slices which represent the S&P 500. So you see the slices down here. And I have 12 slices. S&P 500 has 11 sectors. But one of the sectors that I have that the S&P 500 doesn't have is alternatives. And this is filled up with the private equity firms and one lithium ion company. So lithium, because obviously I think electric cars are going to take over the world, and so therefore we will need lithium. Looking at this portfolio, pretty much every sector is down except really we have one, bonds, which we knew were going to be positive. They're up 15.66%. Technology is up 18%. Healthcare is up 19.5%. No surprise there, given the current state of the world. And that's really it. Everything else is negative. Where I have faith in this portfolio and where I keep putting money in, not that much, but every week I put about $50 into this portfolio and the other portfolios, is I'm putting my money in financials, because I think banks are underappreciated. They're doing really well. They're going to do well coming out of this. And I'm putting my money in energy. No matter how much my belief is in electric cars and a greener world, we're still going to need to burn oil for a while. We're still going to need natural gas. We're still going to need to work our way off of fossil fuels. And right now, pretty much every energy company is beat to hell right now. Everybody's rushing out of them. And I think that's where you catch value. I'll explain that when we get to the growth portfolio and show how I was able to play that really, really well and seeing it pay out during the course of the year. Another sector that I might have some faith in is really utilities, because we all got to keep our electricity on. First thing we pay is our mortgage. Next thing we pay is our utilities. Then everything else follows after that. I think that's going to do well. Industrials are probably a ways off as the economy recovers. But I think this portfolio will actually start doing better once we have some clarity in terms of 2021. And then the dividends will only fuel that growth even more. But I wouldn't be surprised a year from now, this portfolio being up 20%, just because a lot of the companies are all blue chip, high quality companies. And I think that they'll do well in the long term. But that's really it for the dividend portfolio. Disappointment so far year in. But I would say, I'm not investing in this for the market gains. I'm investing in it for the cash. And you can see in 1 year, it's paid me out $240. I even have $6.21 that just came into my account over the weekend. So I'll keep investing in this and continue giving you guys updates. But just goes to show that investing for dividends only is not always the best plan forward. So we'll head over to the growth portfolio and look at that real quickly. So here we are at the growth portfolio, today's focus for the video. As you can see, the portfolio is now worth $13,713. It's up 101.8%. I rounded up to 102%, which equals $5,831. This portfolio is focused on market gains, not on dividends at all. I don't care about dividends. If I had zero on the dividends, I'd be happy with that. But we have $7.33 in dividends. However, we have $5,824 in market gains. So the bulk of the returns in this portfolio has been market gains as planned. And as you can see here, there are two companies that stick out like sore thumbs on the pie chart on your left. One is Tesla, which is now representing 29.3% of the portfolio. It's supposed to be 15% of the portfolio, but it's grown rapidly. The other one is Invitae, which now represents 10.5% of the portfolio when it's supposed to represent 5% of the portfolio. Again, rapid growth there. And then we can see on the chart the value over time. The portfolio is at its all-time high right now. This is exactly a 1 year review. So it's really great to see these strong returns. Now let's go down to the companies and talk about each one of them individually. But there's one thing that you'll see as a theme as we go through these companies, and I'm going to mention it right now. The word is monopoly. These companies have monopolistic positions in their business. So they do really, really well because they dominate the space they're in. We start off with Tesla, which is up 506% in this portfolio. And it's returned $3,256. So I've basically invested maybe less than $1,000 to get to $4,000. It's supposed to be 15% of the portfolio, but instead it's 29.3%. Again, in EVs, this is a monopoly. When it comes to meat substitutes, Beyond Meat is the dominant player there. That company's up 32%. I believe in this because I'm switching over to eating less meat and eating more artificial meat, just like I switched away from regular cow milk to drinking soy and oat milk, as well as almond milk. Lots of my friends have done the same thing. Invitae genetic testing. This company is the example of, this is a great example of cost averaging down. At one point, this stock went all the way down to $6 a share. And I had bought it at something like 30, not 30, it was $24, $25. I've averaged all the way down to $16 or $17. That's why it's at 182% return now. Just goes over the last 3 months, every $50 that comes in every week has been going to Invitae, purposefully targeting the lowest performing company, because I believe in all the companies in this portfolio. Amazon is basically a monopoly when it comes to e-commerce. No need to explain there. They're up 70%. Facebook, when it comes to social media, you might as well just say the social media company, because they pretty much own every platform. I use their WhatsApp a lot. Not a big fan of actual Facebook, but I know a lot of people who are on there and even run businesses on Facebook. Google, impossible to hate this company. Even if you hate them, you have to use them. That's my go-to search engine. YouTube is pretty much where I spend a lot of my time to get news or any information on how to do anything. Microsoft, when it comes to Office and productivity, they dominate that space. If you're in the corporate world like I am, you're on Teams constantly, and you wouldn't be able to do any work without Teams today. So they're going to continue dominating things. Office 365 is just a brilliant strategy to switch over to subscription and to stop all that nonsense with Windows being something you buy every year. Alibaba, this is basically the Amazon of China. And then now the company that I'm buying a lot of, because it's negative, it's down 14%. I'm going to keep buying it while it's on sale right now, is Uber. When it comes to ride hailing, this is the dominant player. I know the Lyft mustache people are probably going to get mad for me saying this, but Lyft is a US play. When you leave the US and you go to any other country, you're going to use Uber because there is no Lyft. So this is just a dominant player that's going to do really well. Uber Eats is really strong. I see it everywhere now. So it's just a matter of time before Uber Freight and all the other things come online and really keep propelling this company forward. Netflix, when it comes to streaming, they own that space. They started that space. They invented that space. They own it. Remember all that nonsense, basically, in the last 8 months, CNBC saying, Disney Plus is going to crush Netflix. The stock went down a lot. They didn't have a lot of subscribers, or they had millions of subscribers, but it apparently wasn't enough. It's a good thing I don't listen to CNBC because the stock is now up 60%. And last but not least, my favorite company in my other portfolio is AMD, up 77%. Really like what they're doing, going after Intel and Nvidia at the same time. It's one of the few companies that plays both in the CPU and the GPU market space, and they're coming out with new innovations in both spaces. So really love the work there, and happy to be invested in that company in my Vanguard account. But that's really it for today's video. This is the growth portfolio. One other thing that I forgot to mention, which I'll say, is you'll notice that in this portfolio I only have 11 stocks, and so it's super concentrated in specific areas. And that's really, when you look at some of the best investors in the world, they don't have a million companies. They really have a few that they focus on. Even Warren Buffett says it best. He stays in his area of competence. And you don't need to invest in 60, 70 companies to actually do well. As you can see, the dividend portfolio is doing far worse than a growth portfolio. And this portfolio is super concentrated. But things can go the other way too. If I just pick the wrong companies, this portfolio could be easily down 50, 60%. So the experiment still continues. This portfolio is up a lot, but I'm doing this for the next 5, 6 years, not for 1 year. Anything can happen in 1 year. Anything can happen in 1 month. We'll just have to see how things play out over the next 4 to 5 years. If you like the video, please give it a thumbs up and share it with others. If you like the concept, I would appreciate if you subscribed. Thanks, and have a great day.